Gold just did something it hasn't done in 46 years. On January 29th, 2026, gold shattered through $5,300 per ounce, then pushed past $5,500, then rocketed toward $5,600 in a matter of days. We're talking about a 99.75% increase compared to last year, nearly double in 12 months. But here's what's really shocking. This isn't a bubble, this isn't speculation, and this definitely isn't over. Central banks are buying gold at triple the historical rate. Investors just poured a record $89 billion into gold ETFs in a single year. And mining companies? They're generating cash flows we haven't seen in half a century. If you're wondering whether you missed the gold rally, stick with me for the next 12 minutes. Because what I'm about to show you suggests we're not at the top, we might just be getting started. Let's put this in perspective. Gold closed 2025 up 65% from where it started the year at $2,606 per ounce. That's the sharpest annual gain since 1979, when gold surged 133% during the inflation crisis that gave us 20% mortgage rates and gas lines around the block. But 2026 started even more aggressively. We're already up another 16% in less than a month. Gold broke 53 new all-time highs in 2025 alone. Trading economics data shows gold reached $5,585 per troy ounce, and analysts are now openly discussing $6,000 as the next psychological barrier. Now here's where it gets interesting. This rally is being driven by something Wall Street calls the perfect storm, and it's a combination of three unstoppable forces. Force number one, dollar weakness. President Trump made headlines when he said he's totally fine with a weaker dollar, citing benefits for U.S. exporters and businesses. This is a radical departure from decades of strong dollar policy maintained by every administration since Reagan. The U.S. dollar index has slid to four-year lows, and there's zero sign it's stabilizing. When the dollar weakens, gold, priced in dollars, becomes more attractive to international buyers. It's that simple. And when the President of the United States publicly endorses dollar weakness, that's a green light for every central bank and sovereign wealth fund on the planet to accelerate their move away from dollar-denominated assets. Force number two, policy uncertainty that's off the charts. Trump's Liberation Day executive order on April 2, 2025, imposed sweeping tariffs on imports from most U.S. trade partners. The World Gold Council called the aftermath a global market meltdown. Major foreign holders like Japan and Canada started selling U.S. treasuries, pushing 10-year bond yields sharply higher. Add repeated presidential criticism of Federal Reserve independence, and you've got an environment where confidence in U.S. institutional stability is wavering. Financial analysts are literally calling this the Sell America trade. When confidence in the world's traditional safe haven assets, U.S. government debt, starts cracking, capital flows into the ultimate safe haven, gold. Force number three, the Federal Reserve walking a tightrope. The Fed held interest rates steady at 3.75% in January. But here's the key detail most people missed. The decision was not unanimous. Two Federal Open Market Committee members dissented in favor of immediate rate cuts. That's internal disagreement at the highest levels of monetary policy. Markets are now pricing in approximately 75 basis points of additional cuts throughout 2026. Lower rates mean lower opportunity cost for holding non-yielding assets like gold. And the Fed's restart of its Treasury bill buying program, what some analysts are calling stealth easing, is keeping liquidity abundant. Bottom line, we've got a weak dollar, unprecedented policy uncertainty, and a Federal Reserve that's probably going to cut rates further. That's rocket fuel for gold prices. Now let's talk about history, because this matters. The last time gold did anything close to this was 1979-1980. Gold surged 133% in 1979, hitting a then record $850 per ounce in January 1980. That peak took nearly 3 decades to surpass. People who bought gold in 1980 didn't see those prices again until 2007. So what's different this time? 3 critical differences that suggest this rally has more room to run. Number 1, the demand structure is completely different. In 1980, the gold rally was driven almost entirely by speculative retail buying and panic. Regular people were lining up at coin shops, convinced the financial system was collapsing. When that panic subsided, gold crashed. Today, central banks, the world's most sophisticated financial institutions, are the primary drivers. They're buying gold at 60 tons per month, more than triple the pre-2022 pace. This isn't panic. This is strategic, long-term asset allocation. According to JP Morgan, central banks will purchase approximately 755 tons of gold in 2026. That's down slightly from the 1,000 plus tons annually we saw over the past 3 years, but it's still nearly double the pre-2022 historical average of 400 to 500 tons. Poland has more than doubled its gold reserves in 2 years. Brazil just made its first gold purchase since July 2021. China's buying is believed to be substantial and continuous, though their reporting is irregular. Kazakhstan, Turkey, India, they're all accumulating. This is a global de-dollarization megatrend, and it's not going to reverse just because gold hits $5,000 or $6,000. These central banks are buying gold to reduce vulnerability to U.S. sanctions, dollar volatility, and Western policy decisions. That's a structural shift, not a temporary trade. Number 2, cost structures in the mining sector are dramatically healthier. In 2011, when gold last peaked around $1,900, soaring energy and labor costs ate up most of the benefit of higher prices. Miners barely made money. Today, all-in sustaining costs average around $1,424 per ounce. With gold above $5,000, major producers are generating profit margins exceeding $3,500 per ounce. That's a super margin environment that we simply didn't have in previous cycles. And unlike 2011, today's mining giants aren't leveraged to the hilt. They're running near zero net debt, paying dividends, buying back stock, and funding next-generation projects, all at the same time. Number 3, the catalyst list is longer and more diverse. In 1979-1980, it was basically just inflation and geopolitical tension from the Iranian hostage crisis and Soviet invasion of Afghanistan. Today, we've got inflation concerns, yes, but also tariff wars, Federal Reserve independence threats, AI bubble concerns pushing investors to hedge equity exposure, unprecedented fiscal deficits, banking system fragility, and escalating tensions across multiple global flashpoints simultaneously. This isn't a single catalyst rally, it's a multi-catalyst environment, which makes it far more resilient. So what are the big players saying? JP Morgan's Gregory Shearer, head of base and precious metal strategy, points out that combined investor and central bank gold demand in Q3 2025 totaled approximately 980 tons, a surge of over 50% compared to the previous 4 quarters. In monetary terms, at an average gold price of $3,458 per ounce, that translated to approximately $109 billion of quarterly demand inflow. That's 90% higher than the average of the previous 4 quarters. JP Morgan Global Research now projects gold pushing toward $5,000 per ounce by Q4 2026, with $6,000 becoming increasingly realistic over the longer term. Bank of America strategists have maintained similarly bullish outlooks, citing continued central bank buying, rising U.S. fiscal deficits tied to proposed policy changes, and sustained dollar weakness as key structural drivers. The World Gold Council, the industry's most authoritative research body, reported that 2025 saw the second strongest year for gold ETF demand on record, with $89 billion in inflows. Their analysis shows that global gold ETF assets under management more than doubled to an all-time high of $559 billion by year-end 2025. Here's a critical insight from their research. Gold's share of total global financial assets has increased to approximately 2.8% as of Q3 2025. But JP Morgan strategists believe 4 to 5% represents an appropriate allocation given current macroeconomic conditions. Do the math. If institutional investors globally moved from 2.8% to even 3.5% allocation to gold, we're talking about hundreds of billions of additional capital flowing into a relatively constrained market. That's not speculation, that's just portfolio rebalancing toward historically normal levels. And here's the kicker. Gold beat analyst consensus forecasts by 25.6% in 2025, the widest margin in the 2-decade history of the London Bullion Market Association's annual polling. Every major bank underestimated gold's performance. Every single one. What does that tell you? It tells you the professional forecasters, people whose entire careers depend on getting these calls right, are still catching up to the new reality of gold as a strategic must-own asset. Now let's talk about the market mechanics, supply and demand, because this is where things get really interesting. On the demand side, we've already discussed central banks buying at triple the historical rate, but let's break down the investor demand explosion, because it's unprecedented. North American funds drove $51 billion in gold ETF inflows during 2025, the strongest annual performance ever. That's 57% of the global total, with US-based funds alone responsible for 99% of North American inflows. But here's what shocked most analysts. Asian markets nearly doubled their gold holdings throughout 2025, attracting $25 billion in total inflows. That's more than all Asian gold ETF inflows combined from 2007, when the first Asian gold ETF launched, through 2024. China announced VAT tax reforms on gold jewelry in November 2025, which drove investment-minded jewelry buyers toward ETFs to avoid the additional tax burden. India recorded positive flows for 8 consecutive months. South Korea jumped in, seeking hedges against volatile stock markets. Europe recorded $12 billion in inflows, reversing 2 consecutive years of losses. Heightened geopolitical tensions, particularly stalled Russia-Ukraine peace negotiations, kept safe haven buying elevated throughout the year. Here's the insider insight most people miss. Trading volume across the global gold market reached an unprecedented $361 billion per day in 2025, a 56% increase compared to 2024. This happened across all market segments. Over-the-counter trading, exchange-traded volumes, and global gold ETF liquidity more than doubled to $7 billion per day. September 2025 was particularly remarkable. Gold ETF trading volumes exploded to $8 billion per day, an 84% month-over-month increase. What does massive trading volume tell us? It tells us this market has deep liquidity, tight spreads, and institutional participation at levels we've never seen before. This isn't a thin, manipulated market. This is a mature, globally traded asset class with broad participation from the world's most sophisticated investors. Now let's talk supply, because gold is unique. Unlike oil or copper or agricultural commodities, gold supply is basically fixed. Annual mine production is around 3,000 to 3,500 tons. It takes 10 to 15 years to bring a new major gold mine from discovery to production, and the easy gold has already been found. All the gold ever mined in human history, about 200,000 tons, would fit in a cube roughly 22 meters on each side. That's smaller than an Olympic swimming pool. And about 50% of that is held as jewelry, 17% by central banks, with the rest split between private investment and industrial uses. Here's the critical point. When demand surges, like we're seeing now, supply can't meaningfully respond. Mining companies can't just produce more gold the way frackers can drill more oil wells when prices spike. The supply is what it is. So you've got structurally constrained supply meeting explosive demand from both central banks and investors. That's economics 101. Price has to rise to clear the market. And remember, central bank buying is price insensitive. They're not buying gold to trade it. They're buying it as a strategic reserve asset to diversify away from dollar exposure. Whether gold is 4,000 or 5,000 or 6,000, they're going to keep buying to hit their target allocation percentages. That creates what analysts call a price floor effect. Even if speculative investors take profits and gold corrects 10 to 15%, central bank buying provides support. That's a fundamental change in market dynamics compared to previous gold bull markets. All right, let's talk numbers. Where could gold go from here? Conservative case, $5,000 to $5,500 consolidation through mid-2026. In this scenario, gold takes a breather after its explosive run, consolidates between $5,000 and $5,500 as investors digest gains and wait for the next catalyst. The Federal Reserve holds rates steady or cuts modestly, dollar weakness stabilizes, and geopolitical tensions remain elevated but don't escalate dramatically. This is basically the pause but don't reverse scenario. Gold holds its gains, central banks keep buying, but momentum investors take some profits. Realistic probability, 35 to 40%. Base case, $6,000 by late 2026 or early 2027. This is where most major investment banks are clustering. JP Morgan has explicitly discussed $6,000 as realistic. In this scenario, the Federal Reserve cuts rates 75 to 100 basis points throughout 2026. The dollar continues weakening, Trump administration trade policies maintain uncertainty, and central bank buying remains robust. Gold pushes through $6,000, not on a blow-off top, but in a measured, steady climb backed by fundamental demand. Realistic probability, 40 to 45%. Bull case, $7,000 plus by 2027. In this scenario, something breaks in the financial system, whether it's a banking crisis, a sovereign debt crisis, or a geopolitical shock that sends safe haven demand through the roof. The Federal Reserve is forced to cut rates more aggressively than currently anticipated. Dollar weakness accelerates into a dollar crisis. Central banks panic buy gold. We've seen this movie before in different contexts. In 1979-1980, gold went from $226 to $850 in roughly 18 months, a nearly 4x move. While that extreme seems unlikely today given gold's current high base, a move from $5,300 to $7,000, $7,500 represents about a 40% gain, which is perfectly plausible if conditions deteriorate. Realistic probability, 15 to 20%. Here's how to think about the math. If central banks continue buying 60 tons per month, 720 tons annually, at an average price of $5,500 per ounce, that's roughly $127 billion per year in central bank demand alone. If investor allocations to gold rise from 2.8% to just 3.5% of global financial assets, that's potentially another $200 to $300 billion flowing into gold ETFs and related products. That's $300+ billion of sustained annual demand, hitting a market where supply is basically fixed and actually declining slightly as older mines deplete faster than new projects come online. Price has to rise to balance that equation. It's not a matter of if, it's a matter of how quickly and how much volatility we see along the way. Now, before you rush out and put your entire portfolio into gold, let's talk about risks, because they're very real. Risk number 1. Gold produces no cash flow. Unlike stocks that pay dividends or bonds that pay interest, gold just sits there. In a world where risk-free treasury bills are yielding 4 to 5%, that opportunity cost matters. If inflation falls and real interest rates rise significantly, gold could underperform. Risk number 2, policy reversal. If the Trump administration somehow achieves policy success, accelerating economic growth, reducing geopolitical tensions, and strengthening the dollar, that removes gold's primary catalysts. Possible? Yes. Likely given current trajectory? Analysts are skeptical, but it's not impossible. Risk number 3, technical correction risk. Gold is up 99% in a year. That's an extraordinary move in any asset class. Technical analysts point out that gold is extremely overbought on virtually every time frame. A 15 to 20% correction wouldn't be surprising or unusual. It would actually be healthy for the long-term bull market. If you buy gold at $5,500 and it corrects to $4,500, are you prepared to hold through that drawdown? That's not a theoretical question. It's a psychological reality that has shaken out countless investors in previous cycles. Risk number 4, mining stock operational risks. If you're looking at gold mining stocks for leveraged exposure, remember, these companies face geological challenges, political risks in operating jurisdictions, execution risk, labor disputes, environmental issues, and cost inflation that can erode margins. Newmont and Barrick have delivered spectacular returns, 167% and 182% respectively in 2025, but that doesn't guarantee future performance. Junior miners are even more volatile. I'm not saying don't invest in gold. I'm saying understand what you're buying and why. Gold is insurance, not speculation. It's portfolio diversification, not a get-rich-quick trade. And it's a long-term strategic holding, not a momentum play. The case for gold is compelling. The structural drivers are real, but so are the risks. Size your positions accordingly. Here's why this matters right now. We're at an inflection point. Gold has broken out to new highs, momentum is accelerating, and institutional adoption is reaching critical mass. The next 6 to 12 months will likely determine whether gold consolidates at these levels or pushes dramatically higher towards $6,000 to $7,000. The data suggests we're in the early to middle innings of a major bull market, not the final stages. Central bank buying isn't stopping, dollar weakness isn't reversing, policy uncertainty isn't going away, and investor allocations to gold are still below historical norms, meaning there's room for substantial additional inflows. If you've been watching gold's rise from the sidelines, wondering if you missed it, the evidence suggests you haven't. But windows of opportunity don't stay open forever. If this analysis was valuable, hit that subscribe button and turn on notifications. I break down complex financial markets into actionable insights twice a week, and you don't want to miss the next one. Drop a comment below. Are you buying gold at these levels, or are you waiting for a pullback? What's your price target for 2026? I read every comment and respond to as many as I can. And if you found this useful, share it with someone who's trying to navigate these markets. This kind of deep dive analysis isn't available everywhere, and the more people who understand what's really happening with gold, the better decisions we can all make. Gold at $5,300, $5,500, $5,600. These aren't just numbers on a chart, they're a signal. A signal that the global financial system is being restructured in real time. that the dollar's multi-decade dominance is facing its first serious challenge since Bretton Woods, that the world's most sophisticated investors, central banks managing trillions, are voting with their wallets, and they're voting for gold. You can ignore that signal. You can dismiss it as a bubble or speculation or fear-mongering, or you can recognize it for what it is, a fundamental shift in how the world stores value and protects wealth. In 1980, the people who understood what was happening bought gold and protected their purchasing power through a decade of stagflation. In 2008, the people who saw the financial crisis coming made fortunes while others lost everything. We're living through another one of those moments. The question is, will you recognize it while it's happening, or will you look back in 5 years wishing you had? This is Your Channel Name, where we cut through the noise and focus on what actually moves markets. I'll see you in the next one.